Okay, you guys should be able to see my screen right now. Can you guys let me know in the chat here if you guys can see me clearly? Why you are always getting in and out of trades at the wrong time and how to fix is what you should be seeing right now. Okay, wonderful. Looks like you guys got it. Thank you, Ewo, Bill, Thomas, Cheryl. Appreciate it. Yep, you got a rocket there. Thanks, Bill Peterson. Great, John. All right, guys. Perfect. Wonderful. Glad to be with you here today. This is my first time on Traders Talk Live, and so I'd be interested to know I want to kind of get a feel for what it is that you guys are generally using for your underlying instruments. So for those of you that are trading futures, can you just put an F in the comments there? Give me a big F in the comments if you're trading futures. If you're trading options, give me an O. Stock, S. We'll say currency, C. And if you're trading Bitcoin, B. All right, lots of Fs. We've got some currency here. Options and currency, Bill. Options, T. Young. Andre, futures. Currency, futures, futures. Lots of futures, folks. Okay, wonderful, wonderful. All right, so we've got a lot of futures traders in here today. Some oil, Bill. Wonderful. Options, Karen. John C. does a little bit of everything. Okay, wonderful. Thank you, guys. Appreciate the participation here. So what I want to talk about here today is an obstacle that will face you regardless of what instrument you choose to trade, and that is getting in and out of positions at the wrong time. This is something that I host a local IBD group. How many of you guys participate in IBD? Investors Business Daily? Probably not a lot of you with you being futures, but I'm sure you're familiar with IBD. So I am a local rep. I guess I sponsor one of the groups here, and at one of our meetings, one of the participants afterwards, we were just chatting, and he came up and he said, "Hey Nick, I've got a great idea for a trade recommendation service." And I said, "Oh yeah, what is that?" And he said, "I'll send out trade ideas, and the only rule is that you've got to do the exact opposite of me." How many of you can relate to that at all? Where the moment you get in, it seems like things kind of go against you. I know this is a common problem. If you can relate to that, say I. Carrie can, Eric, he can. I don't know if you guys can see the chat or not, but this is a Ewo, yes. I, Thomas. Okay, this is something that a lot of us can relate to, and it's a common problem. And so today, I want to talk with you about why this happens, and most importantly, how to fix it. So our goal for today is to help you to walk away with a fast and reliable way to skyrocket your accuracy rate. So let me just briefly introduce you myself, and we'll get right into this. So my name is Nic Lovelace. Again, this is me. I don't know if you can see me on the chat right here. Hope you guys are doing really well. That was just a couple of years ago. But we've got 6 kids, my wife and I, 4 boys, 2 girls. All of them are under 9 years old, so it's quite the crew. And for me, that's why I enjoy doing this, is because it gives me the ability to be with my family and do the things that I value the most in life. Some of the things I enjoy doing is I love fly fishing. I love to fly. I got my pilot's license when I was 17, and I love to ski. Education experience, I attended Brigham Young University, BYU. We just beat Tennessee this weekend. Huge to go into an SEC powerhouse for those of you that are into football. No, it's really not a great football team recently, but did attend Brigham Young University, and as of right now, I am a research officer for a research firm that develops algorithms for institutional traders and finance programs. So one of the things that we do is just to kind of simply help you understand what it is I do there is we develop algorithms for things like the requirements that somebody would have to meet in order for them to get a mortgage from the bank. We put together all those requirements that allows the bank to have confidence that whether the loan works or not, they're going to be successful over the long run. So we develop systems, financial algorithms for institutional traders at AlphaX. I am also a board member and one of our investment officers. I'm an investment officer over at a hedge fund called Wren Capital Management, which is an index options-based hedge fund, and also we started the Super Trader for unqualified investors that aren't capable, they're not allowed to invest in hedge funds. Obviously, you've got to be a qualified investor to invest in hedge funds, which means you've got to be earning at least $250,000 a year and have at least $1 million liquid net worth. And there's a lot of people that fall outside of that scope, but still need to manage their money in a way that is responsible, consistent, and predictable. And so we started the Super Trader for all of our unqualified investors who aren't able to be in our funds. So Bill asked me, am I a trader? So yes, I am. We manage a hedge fund, and I'm the chief investment officer on that fund. So most of the investment decisions flow through me. So yes, very, very much so. I want to take you back though. Remember when you first got started in this? I don't know what brought you here. Maybe you're just getting started. Maybe you've been doing this for a long time, but I want you to remember when you first got started into trading. My assumption here is that most of you probably are fairly successful in whatever vocational pursuits you've had in your life. Maybe you're an engineer, maybe you are a doctor, maybe you're a pharmacist, maybe you're a lawyer, maybe you're a stay-at-home mom that has ran a really tight ship and has done really well. Maybe you're a teacher, maybe you are a truck driver. I don't know what you were. Maybe you're a plumber. But my assumption is that whatever your vocational pursuits, you probably did a really decent job. And when you got into trading, I know that a lot of us think that our success in our vocations translates over to success in the market. And if you've been doing this for any period of time, you know that that's just simply not true. I had one of the individuals that I work with, he owns a plumbing company. He told me, he said, Nick, when I go on 10 jobs, for my company, I'm going to get 10 jobs done. I'm going to finish 10 jobs. I'm going to walk away, succeeding at all 10 of those jobs. And I have a really hard time with trading because if I place 10 trades, I'm not going to be successful in all 10. And psychologically, that's a struggle for me. And so today, what we're going to talk about is this idea that first of all, success from your vocation translates to trading. It doesn't. And although you may be the top dog in your vocational pursuits, you're going up against institutional traders, and we're going to be talking about them in just a moment. This is a different business, folks, and you've got to do things differently. And when I talk about differently, you and I, we don't have problems with people willing to teach us something, right? This industry is filled with hundreds and thousands of people willing to show us how they turned $1,000 into $491,000, willing to tell us the perfect stock trade that's lining up, right? A simple strategy for extra income now. There's a myriad. I mean, I was just sorting through my inbox just the other day, and just last year, I had over 5,200 emails in my inbox from people that wanted to tell me something about trading. And so we don't lack education. So why is it that we continue to struggle so much if we don't lack tremendous amounts of education? All right, I just want you to have some epiphanies here today. We don't lack education. We have plenty of people willing to teach us, yet most of us are still struggling with getting in and out of positions at the right time. So how do we do this? How do we fix this? Of all the problems that you and I face, you have one core obstacle. I ended up interning at Goldman Sachs and did a brief stint at Bridgewater Associates. Bridgewater Associates is the largest hedge fund in the world. And Ray Dalio, one of the things that he always says, again, one of the most successful hedge fund in the world and the largest hedge fund in the world, one of the things that he always says is that you've got a lot of problems, but your success generally is being prevented because of one big problem, just really one, sometimes two, but generally one. And so if you look at your trading and you look at all the problems that you could be having, right? When I ask people, what do you think are the obstacles to you being successful? What do we hear? What do you think? What do you think are the obstacles to you succeeding? Thomas says it's all in your head. Some people may say, I need more money. I need more time. I need a better plan. I need to trade Forex. I need to trade futures. Oh, I've tried this stock thing and that's not working. Carrie says greed, emit emotion around myself. Edwin, consistency. So we have all these problems, and if you'll notice in your inbox, you'll get emails from people every day telling you what your problems are. But the reality is that you and I have one core problem. And if you can fix that problem, everything else kind of falls into line, right? If you need more money, if you could learn how to get in and out of positions at the right time, do you think that problem is solved? Yeah, right? Absolutely. Okay, if you know when to get in and out of positions at the right time, do you have discipline all of a sudden, or is it less emotional? Okay. This is our core problem of all the problems that you and I face. They should all come secondary to this core problem. This is what really you should be spending the majority of your time on, is figuring out a predictable process for getting in and out of positions at the right time. And there's a lot of ways that you can do that. Today, I want to introduce to you at least one of the ways that we've found a high degree of success that maybe you can choose to explore a little bit further for yourself. So one of the first important things that you've got to do and remember is that you've got to know your limitations. Recognize that this is a big ocean and you're a really, really, really small fish in the market. In fact, according to the FINRA, which is the regulatory authority for the financial markets, they recognize two core groups of traders or investors: non-professional designation and professional designation. So whenever you fill out and you open up a new brokerage account, the questions that they ask you are designed to determine a number of things, but one of the things that they're designed to determine is your brokerage has to report to the FINRA whether or not you are professional or non-professional. Now, for those of you futures traders and currency traders, you spend probably quite a bit of time doing this. In fact, it could even be stated that this is somewhat of a job for you, right? Sometimes we think that, because I do this full time, or I'm doing it every day. Boy, I do this for a living, or I'm professional. According to the FINRA, you're probably not designated as a professional. Even if you're trading full-time, doing it for a living, and you've done it for 20 years, you're probably not a professional designation. So a couple of distinctions that the FINRA makes between non-professionals and professionals are these. This is on the FINRA website, finra.org. And one of the ones for non-professionals is that generally our activity has no major impact on the market overall, on individual stocks or the market overall. Okay. Professionals, sometimes referred to as smart money, they include pension funds, hedge funds, banks, insurance companies, and other big investors, high net worth investors. They account for as much as 70% of all trading volume. Okay, and because of their dominance, institutional buying and selling can lead to big price moves in individual stocks and in the market overall. You've got to recognize that, again, you're a small fish in a really, really big ocean. And I just want you to soak this in for a moment. If institutional traders or professional traders, pension funds, hedge funds, banks, insurance companies, other large investors, if they make up 70% of all the volume, when you are going in and buying, who are you probably buying from? If they make up 70% of the volume, who are you probably buying from? Somebody answer that for me in the chat. Who are you probably, just statistically, buying from? If you want to buy something, who are you likely buying from? Thomas says a market maker. Maybe if there's nobody willing to sell. Carrie says hedge fund. I would propose to you that exactly. Edwin says a professional. Dave, professionals. Okay. Earl says that 70%. I would propose to you if you and I make up 30% of overall volume, and professionals make up 70% of overall volume, it's highly probable that whenever we are looking to get into a position, we are taking a position from these guys that they no longer want or that they want. So when we want to buy, that means that we're buying a position from these people who want to sell. Or when we want to sell, who are we selling to? We're selling to these guys who want to be buying. So again, remember that statistically, on the brokerage end of things, retail traders categorically are going to fail almost every time. In fact, on the brokerage side of things, the facts are is that about 90% of you retail traders lose money. Why is that? One of the big reasons is that we're normally on the complete opposite end of the people that actually move the market. We're normally doing the opposite to what the 70% of the people that move this market are doing. We don't want to be doing that. We want to be where they are and doing what they're doing instead of fighting against it. So what I'm here to tell you is that there's a lot of ways that you can determine when to get in and when to get out. You can use technical indicators. You could turn on CNBC. You could trade momentum. You could do all sorts of these things. You could trade unusual activity. There's all sorts of ways. Bollinger Bands, there's all sorts of things that you can do to determine when to get in and when to get out. But what I'm here to tell you is that the fastest and most reliable way for you to succeed is by just following the big guys, okay? Just following the big guys. And let me just give you a sense at how well they actually do. So I don't know how many of you actually listen to investor days at JP Morgan, Bank of America, Goldman Sachs, Bridgewater Associates, things like that. I would imagine a lot of you probably don't, but it's part of my job. And so we listen to most of them and we asked them questions because we invest with some of them. But it was in 2017 at JP Morgan's Investor Day. And they had a 25-page presentation on how all of their businesses were performing, from their mortgage business to their banking and lending businesses, to their trading business. And on page 12 of their presentation, they started to talk about their trading business. All right. Now, their trading activity is wide and varied. It includes currency exchange. It includes derivatives or options. It includes equities. It includes futures. It includes bonds as well. This is a very diverse approach that JP Morgan takes. But on page 12 of this report, they reviewed their trading business for the previous 5 years. I just want you to take a look at this for a moment and recognize a couple of things. Let me just draw your attention to the number of losing days that they had in 2012. Now, this is on an average year of 262 trading days, okay? Recognize that in 2012, they had a whopping 7 losing days, where at the end of the business day, they were net negative. They had a loss. In 2013, they made some big improvements and followed up with no losing positions. Same thing with 2014. They had 2 losing trades. In 2015, somebody must have lost their job, right? And in 2016, just in time to present at their investor day, they reported that they had 0 losing days in 2016. Folks, we're talking about 9 losing trading days out of about a little over 1,260. That's a 99.2% accuracy rate. Now, somebody mentioned, Nic, I think, mentioned high probability strategies. Do you think they're just simply going out there and selling high probability derivatives? I would venture to guess probably not. Now, let me just draw your attention to the massive volatility in their profitability, right? There's not any. There's hardly any volatility from year to year at their profitability. So they made $69 average per day profit in 2012. That's 69 million, all right? 69 million. 72 million average per day in 2013. 67 million in 2014. All 5 years, they averaged out to be $71.1 million average per day in profits. Now, Thomas says they front run their clients. They actually aren't legally allowed to do that. That is something that retail traders become skeptical of institutions because, again, like that's our coping mechanism. Because most often retail traders fail, we start to point the finger and blame these large organizations who are highly successful. They aren't actually front running us, but what they are doing is they are getting into things when we get out, and they're getting out when we get in. Almost every time you and I are going to be on the wrong end of things. And do you think your indicators that you're using, that fancy indicator that somebody just showed you a week ago or whenever, do you think that they probably are already aware of those things and every other retail trader is looking at them? They are. All right. These are, whenever you're doing things that a lot of other retail people probably use, it's probably something that is not going to work for you very long. Okay. So what I want to talk to you today about is how do we actually follow the smart money? Now, there's a really wrong way to do this, and this is a popular thing to talk about right now. A lot of people are talking about this. How many of you have heard of following unusual activity or black box stuff or following, block orders. Anybody ever heard of those things? The wrong way to follow institutional traders or follow the smart money, because again, we want to be on their side. We just want to pick up some scraps from these guys. So we want to follow them, but how do we do that accurately? So the wrong way to do this is coming over here and trying to observe directly what it is that they're doing. So one of the things that I can see here is that somebody, let's just go over here, EEM, all right? So somebody today just purchased 1.2 million shares of EEM, which is the Emerging Markets ETF, for $41.31. Would it be probably safe to say that this is a professional trader? I mean, we're talking about a $1.2 million, 1.2 million shares times $41.31 per share. We're talking about a 49.9, about a $50 million position. How many of you agree that this is probably an institutional trader? Say aye. How many of you, can we just agree on that, that's probably an institutional trader? So if they're buying EEM, what would be the assumption if they're buying the stock? What is EEM going to do if this large investor is throwing $50 million at EEM? What's the assumption? That's likely going to do what? Going to go up, right, Carrie? Exactly right. Okay, that would be the general assumption. And so a lot of us could come over here and do whatever analysis we're inclined to do and justify that, oh man, they must know something, I'm going to go ahead and get into this thing. But what you don't know is we don't know if they bought to open this position. Okay, do we know if they bought to open it? Meaning they actually bought the equity just now? Do we know if they are buying to close the stock? We really have no idea whether or not they bought to open the stock or ETF, or if they bought to close a short position. Exactly, Edwin. They could be closing a short position. We have no idea. What if they are long bonds, all right, and they're utilizing EM as a hedge to that position, wherein they don't expect to make their core return on EM, they expect this to provide a hedge just in case long bonds doesn't work right now. We have no idea what their intentions are, folks. Even when you've got a large investor coming out on CNBC and talking about buying a large stake in Amazon, all right? A very large investor by the name of Warren Buffett just came out on CNBC right over here and said that they were taking a large stake in Amazon. What'd the stock do? It shot up about 5%. And then over the next couple of weeks, proceeded to just drop aggressively. So when you hear somebody on CNBC, some large credible investor coming out and saying, I'm taking a large stake in this stock, we just heard one yesterday that we've got a very large investor, and in fact Donald Trump even talked about it and said this is fantastic. Okay, but we had yesterday Elliott Management took a multi-billion-dollar stake in AT&T, all right? And they publicly told everybody that they were doing this. They took $3.2 billion stake. And what did they say in their report? They said that they see the stock rallying as high as $60. This is the wrong way to follow institutions. is by directly observing what it is that they're doing or saying that they're doing and assuming that we know how that's all going down. The reality is that anytime that you can see what they're doing, you have to assume that you don't really know their intentions. When they tell you on CNBC, I'm taking a $3.2 billion stake in AT&T, you need to assume that they have ulterior motives. So we don't directly follow them. We indirectly follow them. Because of how large they are, their activity impacts the way that the auction operates. When I say auction, the ebb and flow of the market is simply just the auction of the market. All right? There's three things that institutions do, or three effects that are left in the wake of their activity. That's how we follow them. All right? We don't follow them directly. It's like looking at a black hole. Hollywood would make you believe that a black hole looks like this. All right? The reality is we've never really seen a black hole. We don't really know what they look like, but we can detect them based on observing their effect on nearby stars and gas. Notice there's a black hole right here in the middle. All right, here's an animated version of the same thing. All right, we don't really, there's nothing there, it's just black space, but we've got stars orbiting this black space. So we can safely assume that there's a black hole there. It's not emitting light and stars are orbiting it, which must mean that something black has a lot of gravity, and we know that those are black holes. So that's how we observe institutional traders, is by watching for their effects on stocks. So there are three effects that they have on stocks. The three effects that they have on stocks are price clustering or consolidation, price chasms or gaps, and what we view as, or what we call as vertical imbalances. Now, this is a pattern that generally falls in this line. We cluster, we then chasm, followed by a vertical imbalance, and the pattern repeats itself. So where do institutions get involved? If I ask you that question, which of these three price profiles are large institutionals trading, what would you say? A, B, or C? Which one of these three profiles is generally when institutions are transacting business? A, B, or C for me. A, B, or C? Thomas says A. Iwo says B. We've got A, B, A. Clusters, okay, A. Andre, B and C, A, C. Boy, this is like lining up 10 analysts and asking them what they think a stock's going to do. We're getting all sorts of things here. Okay, so you can begin to see why there's so much, disagreement, because everybody's got an opinion. Here's a fact. Okay. Institutions get involved in A. This is a fact, okay? Occasionally, when an institution tries to buy all that they could buy all in one shot, this is when they would be getting in. But what happens then is price will go straight up, it'll come straight back down once they get in. Or if they want to sell their entire position, you have what's called a flash crash, where the market will go drop really quick, come right back up same day. Okay? We have those occasionally, but rarely do they happen. Almost 99.9% of the time, this is the only profile they can get involved in, because that is where there's enough liquidity for them to get into their positions. All right? So let's talk about how this works and why this works this way. And to understand why it works this way, you have to understand the auction process. If you've ever attended an auction, you know that when the auctioneer's job, they have one primary responsibility. Their primary responsibility is to just find fair value. That's it, okay? So when this auctioneer steps up to the plate and begins auctioning off this item, if nobody raises their hand at the introductory price, what does the auctioneer do? He's got an item to sell. If nobody is interested in buying at that price, what does the auctioneer do? Does he keep raising it? What does he do? Exactly right, Carrie. He lowers the price. Exactly, Thomas. He's going to lower the price. If nobody gets interested then, Neil, what's he going to do then again? He's going to lower the price again, right? His only job is to identify where business wants to be done. The moment that there's interested parties, what happens to the auction? It stops going down. And sometimes it'll go back up. Has any business been done yet? If the auction starts going back up, has any business actually been transacted here? No, exactly, Sylvia. It has not. Once the auctioneer gets to a level where business can be transacted, what happens to the auction? Doesn't it flatline? Doesn't it basically stop going higher or lower? It does. And the auction of the market operates that exact same way. And I want to prove it to you. So going back and looking at a couple of things here, and I'm not going to have a lot of time to get into a ton of examples here, but I want to get into a couple of examples to help you see how this operates and to give you a glimpse into how to apply it to your trading. Okay, so let's go take a look at Facebook. Okay, so Facebook ended up having tremendous earnings in January. All right, had tremendous earnings right here all the way back in January. And so it ended up chasming up to this level. Now, a lot of people would say that it ended up moving up to that level because there was some large investor that came in and bought the stock. But again, you and I understand that that's not how auctions operate. They move rapidly higher or rapidly lower because they're simply trying to go to a level wherever the most amount of business wants to be transacted. And so if we take that over to Facebook and focus in on what happened back here in January, and if we were to ask the question, why did it go up so much? Why did it go to where it went to? The answer would be, well, because that's where the most amount of business wanted to be transacted. That's why it went there. Some big buyer didn't come in and buy it down here, and it went straight up. That's generally going to be the case. That's not the case where some big buyer came in and bought it up. So let me walk you through this and show you that this is true. So what we're going to do is we're going to take a look at an intraday view of Facebook back on that day on earnings. All right, so here's earnings. And what do we see? We see this rapid migration of price higher. All right. Now, one of the things that we do with our group is every Wednesday we get together and we identify these institutional zones with our group. And this is something that we identified before their earnings report came out. If I just take you back here, back into January, here's Facebook. And again, there's no possible way for me to make this up. This is something that we did with our group live before they reported earnings. And here's our chart that we came up with. That this was an institutional zone up here. All right. This doesn't look like a standard support or resistance line. This one may look like it. but this doesn't. But if it were to go up, that's where it's likely to go up because that's where the most amount of business wants to be done. Now again, this is before their earnings report. It's trading down at 150. If we come over and take a look at the stock on the intraday basis, look at where price moved to. It went right up to that green line that we had drawn on the daily chart. Do you see that? Again, here is our intraday, or here's our daily chart. There's a green line there. That is an institutional auction zone. Again, here's the intraday move. Look at where price moved to. We rapidly migrated higher right into here. And what did we do? We clustered. But that still doesn't prove that a lot of business wasn't transacted right here that caused the price to go rapidly higher. So what we can do is we can add what we call a volume profile on this. Everybody has access to this tool. Okay? A volume profile allows us to see at what price level did volume actually occur. It displays volume on a horizontal basis. So recognize that we've got a large volume node down here. Notice how thin the volume nodes are right here when price is rapidly going higher. And then all of a sudden, we've got clustering right here, right at that line that we had previously identified in our zones workshop with our group. We went right to that level, and that's where it clustered. When it went beyond that, what did the auction do? Again, it rapidly migrated, or what we call a vertical imbalance, up to the next auction level, which guess what? It was right at that purple line that we had drawn on the daily chart. And what did it do? It clustered there. It actually clustered there for the next several weeks. So this isn't by happenstance that this is operating this way. This is how the auction of the market operates. When you understand how to read the auction process, it gives you an edge. It allows you to know what's going to happen when it comes here. It's going to get held up. When it breaks above that, if you can identify the next auction level, you know what the extension is likely to be and when you need to likely take profits if you're getting bullish. Okay, so identifying these auction zones is what will rapidly increase your accuracy rate. So again, I don't have a lot of time here remaining to go through all of this as we're really out of time. But if this is something that that you connect with, I would encourage you to look into it further, to look into learning how to identify the auction zones. This is applicable to all kinds of traders, all right? And what I was going to go through with I'm out of time now, is I was just going to walk through week by week by week in our zones workshops and walk you through how accurate this really is. Back on September 5th, we identified XLK. And XLK at that time was currently trading really close to all-time highs. This was its major auction zone. This is where the most amount of business had been transacted. We saw lots of clustering in that middle territory. That is where the most amount of business had been transacted. And so we said that when it gets down to there, that's where you get bullish. We didn't know when it was going to come down to there, but that's where you're going to be participating with institutions. So I didn't know that a month and a half later, the markets were in a crash going into the end of the year. But we were prepared for it because we identified these auction areas, and when it came down to them, look at what happened. Rapid migration of price higher, a 15% move higher in just 2 days on this stock, and I'm sorry, about 4 days on this ETF. And that happens over and over again. Micron, right down an institutional auction zone. All right, again, bad news, bad news, bad news. It's all being publicized that they're being affected by tariff increases. And retail traders are scared of what's about to happen. But because we follow institutions, we almost disregard the news and understand that institutional traders are the ones that move everything. And so we're going to assume that now that it's come into this institutional auction zone, it's going to hold support. Again, I can't make this up. This was on September 12th. We did this live with our group September 12th, right here, Micron. Again, there's no possible way I can make this up. This was something that we identified way back then. Here's your chart, right down into an institutional auction zone. What ends up happening? It jumps 17% less than a week. And I've got example after example. I was just going to go through every single week since September of last year and show you how accurate this is. Over and over and over and over again, this operates exactly. It makes your job really easy. You don't have to guess when things are going to go up or when they're going to go down. You just follow where institutions have gotten involved and done business in the past. Okay, this is something that if you've not ever done it before, even if you're brand new, it'll work for you. Again, it's your biggest problem that you face. We have one of our group members that's been with us now since 2014. He sent me this in 2016 after being with us for about 18 months. He said, now my biggest problem is I'm growing in this account so quickly, I have to pay more tax if I want to convert this. I'm making $50,000 per month among all my accounts. It works really well, folks, to follow institutions. It makes your job really easy. So if you've got questions, if you want to look at this a little bit further, we're happy. We've set aside a couple of slots where we'll chat with you about it to see if we'll break down, we'll assess your trading and talk with you about how you can progress more rapidly towards the goals you've got. Say, even if your goals are 10,000 to 200,000, if you want to sit down with us, we've set aside some time over the next 48 hours to do that with you, and we'll do that for absolutely free. We'll basically break down what you're doing, how it's working, what your goals are, and help you to construct a plan to move forward in a more predictable way to accomplish your goals. But you've got to have some experience already and still struggling. And so if that's you, again, I'm running through this. We've got 5 slots open for this. Again, it is free, and we're happy to have a chat with you to see if we can help you apply these things to your trading if you want to explore it further. So, boy, that was I kind of like ran through all that because I think Teddy in the background hinting to me to get off. So, Teddy, that's what I got, man.
Okay. It's fine. Thanks a lot, Nick, for coming out.
Okay.
Okay.